You're welcome to the Economy and Politics Show. I'm Mutu Abasi Abaseko. Last week, the International Monetary Fund, in its Global Economic Outlook for 2014, cut growth projections to 3.8%. This was due to weaker than expected global activity for the first half of the year, and also the uneven growth across the global economy. To give further insight on how these growth projections will impact emerging markets and economies like Nigeria, I spoke with Mr. James Ilori, head of First City Asset Management, to give his perspective and insight on what will be the outcome from this projection.
Well, if economic growth is expected to fall from 4% to 3.8%, it also means that in terms of monetary policy, it has to remain supportive. So you would not expect the central banks to tighten policy anytime soon, even though markets generally are expecting interest rates to rise in the developed economies, the US, the UK, not really the Eurozone. So if, of course, not just the US and the UK, they expect yields to rise over the next 1 year. So that's what markets are expecting. But given the downward review in terms of the economic growth forecast, you would also expect that central banks would take this into consideration. And we saw a slight reflection of that in the minutes of the U.S. Federal Reserve Bank minutes, where even though they were glad to see that economic growth is going to become more sustainable, they still highlighted the fact that they are not satisfied. So on the part of the monetary policy authorities, it looks like rates are going to remain low for longer. Longer could be anything between 9 months to a couple of years, 2 years. Although looking into 2016, that really would be taking it too far. But in the short to medium term, over the next 1 year, given the feedback from the monetary policy authorities, you do not expect interest rates to rise. And markets eventually would also reflect that. Markets are probably ahead of themselves. Investors in financial markets have become too aggressive in terms of their expectations for higher yields. So markets would have to reflect, the impact of the forecast, really, in terms of the yield expectations. And for developing economies, it's also a tough one, really, because global markets have become even more correlated than they used to be. So what happens in developed markets has an impact on developing economies. We are aware of portfolio flows, which have been supportive of the currencies of a lot of countries in developing markets. So if you're thinking in terms of expectations for lower economic growth, you would also expect that central banks in the developing economies would also keep interest rates low. That's going to be challenging for them, because when you look at countries like Nigeria and South Africa, where the rate of inflation has actually been picking up. Nigeria, the rate of inflation increased from 8.3% to 8.5% in August. Year on year, in August, it was 8.5%. In South Africa, inflationary pressure has also been on the upside, which was why the South African Reserve Bank increased the repo rate to 5.75%. So you'd also think that monetary policy authorities in developing economies would step back and take that forecast into consideration in terms of their interest rate outlook. So they probably would not be as aggressive if they are thinking of increasing rates. They would not be as aggressive as they previously were. So, in a nutshell, you'd expect that, given that forecast, if that forecast turns out to be correct and monetary authorities buy into that, they would also leave policy broadly supportive. They would not tighten policy anytime soon.
Also, the United States of America, early 2015, will experience a rise in its yields. This will also lead to some very firm policies from the Fed. How is the global markets, particularly Nigeria, bracing for this, and what will be the impact when the US begins to take firm steps to also tackle its deficits. Mr. Ilori speaks further on this.
The expectation that interest rates are going to increase, for instance, in the U.S., is expected to have a sort of negative impact really on flows to emerging economies. We remember that a lot of investors, international investors who were seeking higher yielding assets, embarked on this thing called carry trade, where you borrow in countries where interest rates are low, so you're borrowing at a low rate, and you invest in countries where interest rates are higher. So that's carry trade, and you then hope that you're able to manage the interest rate risk. So we've seen a lot of that. So you're going to expect to see a reversal of flows in that sense. And once you see a reversal, that's going to put a lot of pressure on the currencies of emerging economies. Nigeria, for instance, the estimates of portfolio flows into the country is roughly between 10 to 15 billion of Nigeria's foreign reserves of about 40. If you expect that part of those flows are more hot money, so they're more speculative, you'd also expect that if you have outflows, that would have a negative impact on the Naira, which formed the basis for sort of our forecast, really, that the Naira is probably going to weaken over the next 1 year and close September 164. We factored that into our model. It's one of the variables. It's not the only variable, but that's one of the variables. And we also think that because the central bank, our projection, in-house projection, is that the Central Bank of Nigeria is going to cut the monetary policy rate by 100 basis points over the next 1 year to 11%. And once that happens, for these portfolio investors, we expect yields to rise in the U.S., and then we expect the Central Bank of Nigeria to cut the policy rate. So it just puts more pressure on these portfolio investors to move their funds somewhere else, which is a negative for the Naira. And if Naira weakens, you'd also expect to see that flow into the rate of inflation in the country.
As we approach a very critical period in Nigeria, which is the 2015 general elections, inflation has been on the rise for consecutive 6 times now. It's been on 8.5% and is likely to also spike to above 9%. How is the CBN going to tackle this, and what will be the impact on the economy? Mr. James Ilori continues to give his insight on this.
Remember that when the new central bank governor assumed office, his first statement was that he was looking to ease policy, and then subsequently he made an amendment to that statement to the fact that it's not going to happen in the near term. But we think that after the elections, the central bank is going to be under a lot of pressure to ease policy to support economic growth. Yes, inflation would be an issue up until the period of the election, but we think after the election, as I said, you've got a lot of inflows, portfolio investors coming into Nigeria. Some of these portfolio investors are actually asset managers like ourselves, and they have a long-term view, a medium to long-term view of the Nigerian economy. So if I'm asked to estimate what percentage of portfolio flows would actually leave if interest rates are cut and if rates in the U.S. rise, I probably would be looking at, it's just an estimate really, I probably be looking at 10 to 20%, which would not do a lot of damage to the Nigerian economy. Yes, inflation would spike in the run-up to the elections, but after the elections, we think inflationary pressure would remain sort of stable. It would not increase significantly. So, in that sense, we're very optimistic that the central bank would actually be able to cut interest rates, and that even if you have outflows, it would not be material enough to stop the central bank from actually easing policy. The Nigerian economy is growing. The economy needs a lot of support, and we think the central bank is going to act to ensure that the environment remains supportive and also ease policy.
The global economic slowdown is really a big challenge, and this calls for concerted efforts for policymakers in Nigeria particularly to understand how they will navigate through the tide. And that will be all for this edition of the Economy and Politics Show. To log on for further information and insight and engagement, the site is www.webtvng.com, and we are very interactive, so you could visit our social media platforms, Facebook and Twitter, for further interactions. Till next edition, thank you for watching and have a lovely day.